Have you ever just stared at a chart and wondered, how in the world could I predict the high or low of the day before it even happens? Well, today, we're going to break down one of the most powerful concepts ICT teaches for framing your entire trading day. Welcome to AI Explains ICT. In this video, we are diving deep into the core content from Month 8, Episode 3. And trust me, you're going to want to grab a notepad for this one. The details here are absolutely crucial. So let's just jump right into the core problem every single day trader faces. You've done your homework, you have a directional bias. You think the market's going to go up or it's going to go down. But where? Where specifically is that major turning point likely to happen? How can you possibly anticipate the daily high or the daily low before it actually forms?
I mean, it really sounds like the million-dollar question, doesn't it? But what if I told you there was a specific tool, a framework, that's designed to give you a high probability zone for exactly where that daily extreme could form? That is precisely what we're going to unpack today.
And the answer to that question is a concept called the central bank dealer's range. Think of this as the framework, the blueprint for the entire trading day that's about to unfold.
So what is it really? Well, the central bank dealer's range, or CBDR for short, is simply a price range that forms during a very specific window of time. The real magic, though, is that we can take the size of this range and use it to project or forecast where the high or low of the day is most likely to print.
Okay, and this is where you really need to pay attention, because the parameters are everything. The time window is set in stone. It's from 2 p.m. to 8 p.m. New York time, no exceptions. The size of the range during that window is also super important. Ideally, we're looking for a nice, tight range of about 20 to 30 pips. And here's the hard rule. It must be less than 40 pips. Why? Because as ICT explains, any range that's bigger than that just tends to be messy and not very useful for making accurate projections.
All right, so let's say we've found our valid range. Now what? How do we actually use it to forecast anything? Well, that's where standard deviations come into play. We're going to use them to measure out potential market moves. And this visual really says it all. The best way to think about this is that the central bank dealer's range is your home base. It's your starting point. The standard deviations are just measured steps. You're literally taking the size of that range and stacking it on top of and below your home base. They're predictable, calculated levels. And don't worry, the math here is incredibly simple. First, you just measure the size of your CBDR in pips. Let's just say it's 25 pips, right? To get your first standard deviation up, you just add 25 pips to the high of that range. To get the first one down, you subtract 25 pips from the low. Then you just keep doing that over and over for +2, +3, and +4, and -2, 3, and 4. That's it. So where are we actually looking for the price to turn? It's pretty simple. On a day where you're bearish, a sell day, you'll be looking for the high of the day to form somewhere between the top of the CBDR and about 3 standard deviations above it, and, you guessed it, on a buy day, when you're bullish, you'll be looking for the low of the day to form within 3 standard deviations below the range. Now, price can definitely stretch out to those 3rd or even 4th deviation levels, especially if there's some high-impact news, but the highest probability setups, the A-plus trades that ICT talks about, often happen much closer to home. Ideally, you want to see that high or low form within just 1 or 2 standard deviations of the original range.
Okay, knowing the theory is one thing, but applying it correctly in the real world, that requires a few key rules. This is how we refine our approach and really stack the odds in our favor.
And the very first rule is how you measure the range itself. You've got 2 options, wicks or bodies. You could use the wicks, the absolute highest high and lowest low, but ICT points out that wicks can have erroneous price spikes from things like broker spreads, and they often just reflect retail panic. The preferred method, the professional way, is to use the candle bodies. This really hones in on where the bulk of the trading volume was, and it gives you a much cleaner picture of what the institutions, the smart money, were actually up to.
And don't just take my word for it. Here's a direct quote from ICT that just drives this point home. If we focus primarily on the bodies of the candles, we're going to get more closer to what smart money is doing. It's all about filtering out that market noise to see the real institutional footprint.
All right, listen up because this next point is absolutely 100% crucial. You cannot forget this. The CBDR is not a crystal ball. It does not, and I repeat, does not tell you if the market is going up or down. You must have your own directional bias first. This is a framing tool. It helps you answer the question of where the turn might happen, not if it will happen.
All right, enough theory. I think we've got the rules down. Now let's dive into some real chart examples from ICT and see how this all comes together when the market is live.
Okay, check out this first example. The CBDR, measured using the bodies, is a super tight 13 pips. That's well within our rules, so it's a go. We project that range up once, and then a second time. And would you look at that? The second standard deviation level nails the high of the day perfectly, right in the London session. That is just a picture-perfect example.
Now for a little contrast, let's look at the very next day. The range here is a whopping 58 pips. That immediately breaks our number one rule of needing to be under 40 pips. So what do we do on this day? Nothing. We simply cannot use this technique. This is not a high probability setup, so we completely ignore any projections from it. Discipline is everything here.
And here we have another absolute beauty of an example. The range is 16 pips, so it's a valid setup. Let's say we have a bullish bias, so we're projecting downwards to find a potential low. Look what happens. The second standard deviation projection absolutely nails the low of the day. It was only off by a single pip before the price just ripped higher. That is incredible, surgical precision.
And when we put it all together, this chart just brilliantly shows the power of having a solid framework. You can clearly see that on the days where the range size rule was met, the projections consistently helped frame the daily extremes. And the days it didn't work, those were the days the rules told us to sit on our hands anyway. See, this isn't about being right 100% of the time. It's about having a framework that gives you a real statistical edge.
So if there's one thing you take away from this, let it be this. The central bank dealers range is not a standalone system. It is an incredibly powerful framing tool that, when you combine it with your own analysis and your own directional bias, can help you anticipate those key daily turning points with a much, much higher degree of accuracy.
Hey, if you found this breakdown helpful, do me a favor and hit that like button and make sure you subscribe to the channel for more. If you have any questions at all, just drop them in the comments below and a real human will get back to you. Stay safe out there and happy trading.